Okay, hello everyone. Very good evening. Thank you for joining with us again on a Friday evening for our weekly show, Ab India Karega Invest. And like every week, this week also we have got a very interesting topic for you. I am Rishabh Lunia from Novice Learning Academy, and today with me would be joining Mr. Ajay Tyagi, who is the Executive Vice President and Fund Manager from UTI Mutual Fund. So a lot of people keep hearing this that okay, investments are best in long term. Always invest and keep your money for long term. So today, what we have chosen for you is understanding why long term investing is so crucial and how it can benefit your portfolio. So today's topic is power of long term investing, and we would be hearing from Ajay Tyagi in a brief. So before that, I will quickly share a small presentation to give you an overview, and then we will hand it over to the guest speaker, after which we will hear from Shikhar, who will talk on the Groww platform. And once all the speakers are done, we will move to the Q&A session. So you can start putting all your questions while the session is on in the chat option, and our moderators will pick it from there and will present it to the guest speaker. So let's quickly start today's session. Yes, so investments are best kept for long terms, will yield positive results for your portfolio. I think all of us have heard this n number of times. So, what's the background? Uh, so, generally, there was a marshmallow experiment which was done in Stanford University. So, quickly, I would like to run you through that experiment and then would try to relate that with investing. So this experiment was done in 1972 by a professor there in Stanford University called Walter Mischel. And what he did was he put various children so in each classroom he has put one child, and they have given a candy, a marshmallow in front of them. And he told that if you wait for 5 minutes, 10 minutes, you will get it too. Either you can have it now, okay, you will get one, or if you wait for about 10 odd minutes, you will get double the benefit of this. And then when they were given these choices, the professor was looking with the help of cameras. They were keeping a view on all the children that what exactly they're doing with these options. And to their surprise, a small lot of kids, let's say about some out of total kids involved, actually waited for about 10-15 minutes. So they went ahead and carried this experiment little longer in their lives, and later they realized that all those people who actually waited for marshmallow for the second benefit, which is like 2 second marshmallow, actually did better in life. So whether it is their SAT scores, whether it is their BMI, the body mass index, and other life parameters. So this is just one study which suggests that when you delay your gratification, okay, because some of them they immediately took the benefit and ate that marshmallow, while the a smaller lot of group of people who actually waited and benefited in the process. So investing is also like this. A lot of us try to get the instant gratification. We see, okay, 100 rupee stock have moved to 200, and we want to book that profit. We don't, or rather we actually miss out on the opportunity which that 100 can become 1000 or 2000. Many stocks have done that in the past. So delayed gratification is one quality which a long term investor should possess in order to make a good multi-bagger returns in our market. Now, while we talk about long term, there are few things which we need to keep in mind, and we'll need to be doing it hands on to make sure that our portfolio is giving us consistent returns. So, first and foremost is whenever you are thinking long term, keep your financial goals in place. Many a times I've seen people are doing investment, but they are not very clear that what is the purpose of their investments, which can become misleading at times. So whenever you are investing, no matter how small that amount be, link that amount to any financial goal. Then you would be more clearer, and then you will not utilize that money for any other goal. So once your financial goals are set, you are in order to your long-term journey. So once you are done with that, the second step which comes is your asset allocation. uh, like one asset is never a solution. No matter how good equity may sound, there are role of other asset classes in your portfolio also. So a lot of people have made this mistake in the past by going overboard on one single assets. So how should we go about doing asset allocation, and why there is such an important need? So here I have taken last 10 years various asset classes and how they have moved up and down in last 10 years. So some year gold has done good, some year mid caps and done good. There were years when international equities have good. So there is a need of a multi-asset portfolio today. You cannot bank on one asset and be sorted for your long term. Second, fund selection is also very important. Many a time we see that people just go and take a shorter route by going to the online searches and seeing what is the last best performance of last 1 year, and they invest into that. So that is never going to be a solution. So what you need to do is, again, just to give you a relative example, a lot of people after seeing 2007 performance, just before the fall, they had invested into infra stocks in a big way. And we all know from 2008 to 2014, infra was actually flat. It has not given any kind of return. So when you follow a seasonal fund or a sectoral fund, as you know, they are more risky in nature. So one, you need to know the risk of that sector. And second, you need to invest a amount which you are ready to take that risk. Never invest your core portfolio into such fund because it poses high risk. So while I say what is core portfolio, whenever you are investing, make sure that you invest 70 to 80%, a bulk of your portfolio, into core portfolio. Now, based on your age, your core portfolio may be differ. For a young person, probably he may have a higher allocation towards mid cap in a core portfolio, but large cap, multi cap, ELSs, these are fundamentally good funds, and you can keep these funds in your core portfolio. The balanced 20-30%, you can try it out with the satellite components, which can be decided based on market performance. And third, and the foremost thing is, always try to be systematic, be regularly investing into markets. So long term investing is not that you have just done one investment and then you forget it. So if you have a chance, make it systematic. So SIPs have been a household name now. Everyone is into systematic investment, but still there are a lot of misconceptions around SIP which we need to break. One, a lot of people feel that SIP is a separate mutual fund product. No, it is just a way of entering into any mutual fund scheme. SIP generates consistent returns. A lot of people feel no, SIP can also move up and down depending on market performances. So these are certain things which you need to understand before you invest for long term. Now, a lot of people want to invest for one-time investments into markets, but they fear that markets are almost close to all-time high. So is it a right time? So there are products like systematic transfer plans, which you can use to systematically get into the mutual fund investment. So first you put your money into a liquid fund or a relatively lesser risky product like a short-term debt product, and then slowly move it over a period of time to equity. So these options are also there. And also, while you withdraw, um, there is another plan which you can use, which is called a systematic withdrawal plan, which is very, very similar to traveling on a highway road. So suppose you are moving on a highway and after 10 kilometers, you need to take a exit, which is coming, which is closer to your destination. Then you will not suddenly go and take a 90-degree left. You will slow down from 100 to 80 to 60, and slowly you will take that left turn. So similarly, when you are approaching your financial goals, slowly you should slow down. That means you should move from equity to a less risky asset, which can be a debt or a balanced portfolio, and then move out of your portfolio into debt, so that you are ready for your financial goal. So like this, these are various strategies which you can follow in long term to make sure that you are inching towards all your financial goal in a right possible manner. I would just like to end this with a small story. Investing is like Chinese bamboo shoots. So all these bamboo shoot, some of you would have heard this story. These bamboo trees takes almost 5 years to just come out from their roots. So till 5 years, you need to keep them water, you need to provide them sunlight, and you will not see any trace above the ground. They are just developing their roots below the ground. So investing is also like this. First 3 4 years, 5 years, you may not see magical compounding benefit, but after 5 years, as you become old, so in next, once those 5 years are over, the bamboo shoot, once they come out, in 5 weeks they can grow as long as 90 meters. So once that initial gestation period of investing is also over, you will see good returns in your portfolio. So patience is very, very essential for long term investing and quality investment also. So with this, I would like to call the guest speaker of the day, who will tell us, okay, why this long term investing is so essential in our portfolio and how you can achieve that by doing some strategic things. So over to you, Mr. Ajay, and I'll quickly share the presentation.
Yeah, thanks a lot, Rishabh, and welcome everyone. So, Rishabh, you've provided me a very solid foundation to actually build on today's session, because the core topic of discussion that we have in front of us today is how to think long term and how to actually be a very successful equity investor. To my mind, the most important aspect to actually be a successful investor and to actually truly benefit from the power of compounding of equities is to really think about being a fractional owner in a business, because essentially that is what all of us do when we become shareholders in a fund, in a firm. When you as investors invest into mutual funds, as portfolio managers, we use that capital to in turn invest into businesses. And when we do that, we become owners of those businesses. And if we are truly owners of those businesses, then it is absolutely important for us to think like the promoters of that firm. And if you are a promoter of any firm, you would not be moved by what is the price that your firm is commanding from 1 month to another or 1 quarter to another. You will be more interested in knowing the outcomes of your firm or outcomes of your business over the next 3 to 5 years. Is the business moving in the right direction? Is the business profitable? Is the business creating value? Is the business showing growth? And so on. Those are the most important factors for any management, any promoter, any shareholder. And like I mentioned, we too are shareholders in businesses. We may be what is known as minority shareholders, whereas the majority shareholders could be the promoters or the management. But nonetheless, if we really have to exploit the power of equity investments, we have to think like what the promoters of the business have been thinking, and therefore we have to think like owners of the business. That's the entire, I would say, reason that's all of today's session. And I would use this presentation to quickly guide you through these concepts. What I have attempted in this presentation is picked up the relevant quotations from world's best investors, economists, investment gurus, and so on. Yes, Rishabh, we can move ahead. So coming up on your chart are the logos of a few companies, as you can see: TCS, Maruti, Asian Paints, HDFC, Torrent Pharma, Marico. Next one, please, Rishabh. And a few more like Bajaj Finance, Jockey, Kotak, Pidilite, Eicher, and so on. So the very easy thing to pick up by looking at these 10 companies is that they have been strong wealth creators. But the more important point is that why have these companies basically created wealth? The immediate reply to that is that they have been all high quality businesses. You see, you can never create wealth by investing into poor businesses. If I were to ask you, tell me names of 10, 20, 30 great wealth creators, I'm sure these 10 names that came up on your screen would have been thrown out by you guys. In addition, maybe another 10, 15, 20 more, but I can assure you, collectively as a group, you wouldn't have been able to throw out 100 names or 200 names or 300 names, because the fact remains there aren't as many great long-term wealth creators. There haven't been as many strong businesses which have created sustainable, durable wealth for investors in the fullness of time. There have only been very, very few selected set of companies which have done that. Every decade, maybe 5 to 10 new companies get added to this list, no more than that. Now, why have all these companies basically created wealth? Yeah, Rishabh. First of all, we need to understand this concept very, very well. And this is the only technical aspect that is there in our presentation. All other things are fairly straightforward and very, very simple to understand. But I'll appreciate your attention for the next 2 minutes on these concepts. Number one, return on equity of a business has to be strong and it has to be durable. What is return on equity? If you put in 100 crores of investments into a business, let's say you start a hotel in the city of Delhi, and let's say you don't put any bit of your capital. It's a hypothetical situation, but you don't put any capital of your own. All of this 100 crores is borrowed capital from HDFC Bank. You have a very close friend working there who's helped you get this 100 crores of project basis the project report that you had prepared, and the bank charges you 12% interest per annum. This 12% is known as the cost of capital. I'm using the words equity and capital interchangeably. Therefore, return on equity and return on capital interchangeably for the purpose of this quick discussion. So you have to pay on that 100 crores of borrowed money, 12 crores every year to the bank. Only after paying back 12 crores will you be left with something for yourself. So your business has to be such which first of all at least creates what is known as 12% return on capital. On 100 crores, after meeting all of your expenses, you should be left with at least 12 crores. But those 12 crores will go back to the bank. When you pay it back to the bank, what are you left with as an equity holder who's put up so much of sweat into this project? You're left with zero. So at 12% return on capital, the business is not creating any value. If you are working with a 15% return on capital after meeting all expenses and then paying back 12 crores to the bank, you are left with 3 crores for yourself. Not a bad outcome, but not an excellent outcome. Now just imagine if you keep going up this curve. Suppose the business is generating 25% return on equity or 50% or 70%. Just imagine the amount of value, and I'm using the word very carefully. Please mark this word. Just imagine the amount of value that business is creating to its equity shareholders. That's the power of a Nestle or a Unilever or a TCS. These businesses operate at 50% return on capital or higher, businesses like Nestle at 70%. Just imagine a business with 70% return on capital and just imagine a business with 12, 15, 17% return on capital. You will understand the drift. Higher you go on return on equity, and that return on equity has to be durable, the higher wealth you will create because the business adds tremendous value. Unfortunately, these are not concepts that we discuss when we discuss whether we should invest into metals because metals are going up. Should we invest into SBI because PSU banks are expected to go up? The minute you were to study their track record on return on equity, return on assets, return on capital, you will realize in the long run, they will not create sustainable wealth for you. Going back to Rishabh's words, you need delayed gratification and you need huge amount of patience for long-term wealth creation. You have to look at the basic concepts of what creates value. If value is not being created, sustainable wealth will not be created. All that you are attempting to do is speculation, but by just trying to figure out where to invest for the next 6 months, what are the stocks that will do well, what are the sectors that will do well, position yourself for those and then hope to move on from there into something else which will do better in the next 6 months. That's nothing but speculation, and that is not acting as a part owner of a business or a owner of a firm, which is what we're trying to attempt. Next, please, Rishabh. So High return on equity also means high cash flow generation. High cash flow generation, you can imagine, means very low debt on the balance sheet. If you are having high amount of cash generation, let's continue with this example. Suppose the business generates 50% return on capital, which means after paying 12 crores to the banks, you're left with 38 crores. You may take back home 10 crores, and the remaining 28 crores you will use to basically pay back the debt. And you do it for 3-4 years, you become debt free. As you keep proceeding ahead, basically you would then keep accumulating cash, and that is what I mean by saying high return on equity would lead to high cash flow generation, would lead to low debt. Essentially, you are creating economic value. Believe me, sustainable wealth can be built only on the back of value creation and nothing else. Yes, please. Now, this is what Warren Buffett has to say. Obviously, you should not trust me because I have no great track record to actually sound as if I am speaking gospel truth. But if you do have respect for Warren Buffett, then you will basically realize what I'm trying to say. The primary test of a good business is the achievement of high return on equity and not achievement of consistent gains in earnings per share, because EPS or profits can keep rising on an ever increasing capital base. I will leave the second part for discussion later. Just realize the first part. For a good business, it has to have high return on equity, like I just explained. 30 is better than 20, 40 is better than 30, 70 is much, much better than these. And there are very, very few businesses with such kind of return ratios. I showcase them in the first slide. Charlie Munger, the partner of Warren Buffett, says a similar thing. The best way to make money is to buy great businesses that can earn high return on capital and can continue to do so for a long, long period of time. Even if you buy an expensive looking business at an expensive looking price rather, you will still end up with one hell of a result. In my 21 years of career with UTI as an analyst and a fund manager, I have never seen HDFC Bank rate cheap. I have never seen.
Hi Ajay, sorry to disturb. I think there is some disturbance from your end. Can you just check your connection once? There's some distortion which is happening with the. Can you say something? Yeah, it's still there.
Is it any better?
Yeah, so apart from your voice, there is some disturbing noise which is also coming along with it.
Okay, is it any better now?
No, just switch off your video once and just check whether it is getting some better. Just say something.
Yeah. Am I sounding any better?
No, I think it's still there. So it's not with the video. Second. You just try once.
Hello.
I think.
Am I audible?
Yeah, you're audible. But apart from that, there is that noise also, which is constantly there. Okay, you just continue. We'll see if it persists.
Hello.
Yeah.
No, I can't hear you guys now. Unfortunately, I don't know what's the reason.
Okay. Fine. So what I'll do is, in the meantime, I'll ask Shikhar to take over, and you can just drop once and again connect. We'll see.
Okay. Just give me a moment, please.
Hello, Rishabh. Can you hear me?
Yeah, Mr. Ajay, I can hear you, but your voice is still quite distorted. So what we are doing is, you can just reconnect once. In the meantime, I'll ask Shikhar to take over. I think he's not able to hear us.
I think I'll finish my part in between, and in the meantime, I think
I'll just try to reach him.
Sure. Okay. Could you stop sharing your
Is it
screen?
any better?
Okay. Okay. I will share my screen now. Till then, we'll see if we can resolve the sound issue. But for now, I'll present. So, welcome to Ab India Karega Invest. I will be talking to you about Groww, the product that we have, the products that we'll be offering in this, and we'll be taking all your questions about Groww towards the end when the three of us take questions regarding investments, your personal finance, and Groww. Right. So I will just very quickly share my screen. Right. So I guess you can see my screen now. So when you download the Groww app, this is the screen you see the very first time, right? This is how you log in. So here you have to log in. You have to if you don't have if you've not logged in, you have to create an account. And those who have already done the creation of an account on Groww, you'd know that creating an account on Groww is extremely simple. It's done via a smartphone or your laptop. It's 100% paperless. And even if you've not done your KYC, we'll get it done for you. When you log in, this is the first screen you'll see. So this is what we call the Explore screen. And this is divided into three parts. It is divided into stocks, mutual funds, and gold. In the top portion, you can see there's a search bar where you can type the name of a stock, a mutual fund, an ETF, anything that you would want to invest in, and you'll be able to see a drop down with those suggestions. In the Explore screen, in each of these tabs, there's sort of an introduction to each of those investments. Like, for example, here, the tab is on mutual funds. So you can see the first option is popular mutual funds. These are some of the most commonly invested mutual funds on Groww. Then you have collection. So in this case, we have put a bunch of mutual funds that are similar in nature together. So you have high returns, tax saving, better than FD, and so on. Likewise, if you scroll down, you'll see other such options. Now, if you tap on the stocks option, you will end up on a page like this. This is the stocks explore screen where you have stocks relevant stuff. So to start off with, we have market indices, then we have top gainers, further we'll have top losers, and so on and so forth. And likewise, the third option is gold. In gold, we right now have partnered with Augmont Digital Gold. So you can invest in Augmont Digital Gold. And in the future, we'll be adding more gold options. Now, whenever you type the name of a mutual fund or you see a mutual fund and tap on the name, you'll end up on a screen that looks like this. This is what we call the mutual fund screen. In this screen, you will be able to see all possible details that you should know about a mutual fund as an investor. So be it past returns over different periods of time, the fund manager's name, the holdings, what are the other mutual funds that compare similarly, their returns, all of those things you'll be able to see on this page. And likewise, you have the stocks page where you'll be able to see all details of a stock. And along similar lines, you have the gold page. Now, moving on, there's something that not many investors tend to miss in case of mutual funds, which is you can invest in mutual funds on a monthly basis or using an SIP, or you can also invest one time, wherein you are investing only one time. You don't need to go on investing every month, right? So this is one feature. People know about SIP very often, but they somehow seem to miss out on the one-time part of it. So that's why we told you this. This is the dashboard. So first part was explore screen. Now we're in the dashboard screen. In the dashboard screen also, we have three tabs: stocks, mutual funds, and gold. So dashboard refers to your investments, your money on Groww. So on mutual funds, you will have your mutual fund investments displayed. So in this case, you can see there are a bunch of mutual fund names. And when you tap on any one of these names, you'll get an option that looks like this. So you can invest more, or you can take out money from that mutual fund. Of course, if it's a tax saving mutual fund, then there'll be a lock-in applicable, which is of 3 years. But for all other mutual funds, for most other mutual funds, you can take out the money instantly. That would depend on mutual fund to mutual fund. Now, here you can see there's another button which says more details. When you tap on that, you end up on a page that shows all your details with regards to that specific mutual fund. So your folio number, all your transactions, investments, and redemptions, your average NAV value, all of that is very clearly mentioned on that page. Moving on, we come to the import and switch feature. This is an extremely popular feature on Groww. So let's talk of import. Import allows you to get mutual funds from somewhere else onto Groww. So let's say you use another platform, you used another medium to invest in a mutual fund, and now you would like to move it to Groww so that you have all your mutual funds in one place. You can do that using import. Import option is available on the dashboard in the mutual fund tab right at the bottom. So scroll to the bottom and you'll be able to see an import option. Switch is the next part of import that many users love to use. Switch allows you to convert your regular mutual fund to direct plan. So when you invest outside Groww, many times, not all times, but many times you will have you would have invested in the regular plan of a mutual fund wherein you're paying some kind of a commission. If you change that to direct, you will not have to pay any commission. So therefore, you will be able to earn slightly higher returns. So the way this goes is first you have to import your mutual funds to Groww. And as soon as you have imported them to Groww, then you will also get the option to switch to direct plan. Groww Digest. So this is a mailer that we send out Monday to Friday and on Sundays. So it's a daily and weekly newsletter that we send out. We try and cover all sorts of things that an investor must learn. So in the daily digest, you have news that we feel every investor should know. It's very condensed. It's very free of jargon. It's very easy and simple to read. Anybody can read it. And it's not heavy. So we only put those news materials that we feel people should absolutely know, right? So that is that. And weekly usually works on a similar principle. It has a little bit more learned content. So please, if you have signed up on Groww, please do check your inbox. You would be getting these mails. If not, you can go to this link, groww.in/digest, where you will be able to read these digests. If you have any questions, doubts for us, please do reach out to us and email us at support@groww.in. Besides this, you can also go to the help and support section within the Groww app or the Groww website, wherein you will be able to find queries answered very easily, failing which you can raise a ticket. You can reach us after you've raised a ticket. You can reach us by phone, by email, and also by chatting with us. Please do follow us on Facebook, Twitter, LinkedIn, and YouTube. We have multiple YouTube channels now supporting multiple languages. There's many regional languages are also covered now. So you have Malayalam, Kannada, Telugu, and a bunch of others. So please do check out our YouTube channel, whichever language suits you, because we do put a lot of content out, which helps many new investors get started. With that, I reached the end of my presentation. I think now we can move on to the next presentation from here, after which we will take questions from the audience.
Thanks, Shikhar. We'll quickly move to Mr. Ajay and check if Mr. Ajay, if you can hear us.
Yeah, I can hear you very clear,
yeah,
but I'm not sure whether
your voice is also perfect now. I think I'll quickly share the screen and I think we can start.
Okay. So I was basically on the return on equity, and
you can try switching on your video. We'll just see if the voice is similar.
Right. So like I was saying, Charlie Munger, who's the partner of Warren Buffett, has also reiterated the importance of return on equity or return on capital. And the point he makes is that even if you buy something which looks expensive, but inherently the business has the ability to generate strong return on capital, you would end up making great wealth for yourselves in the long run. And if you look around yourself, you wouldn't have ever seen Nestle trade cheap. You would have never seen HDFC Bank trade cheap or Kotak Bank trade cheap. Yet, from what we call as an expensive looking starting point, if you still held on to these businesses for 5, 10, 15 years, you did have a very fair chance of creating great wealth. Next, please. Now, these are all high quality businesses that I mentioned. And if you go ahead, again, Warren Buffett basically reiterates that by thinking and investing long term, or just by lengthening the time you stay with a good business, you can create wealth you could have never imagined. All of us are aware that compounding is the eighth wonder of the world. We have heard this many times, but what we are not aware about is basically the fact that for that compounding to happen, you have to stay the course. You have to stick on to these great businesses to actually eke out great returns. And this is what I think is the behavior of investors in the market almost every other day. Suppose you wish to drive from Delhi to Jaipur, a distance which takes you about, let's say, 4 hours. And suppose you're trying to cover this distance in your favorite car, trying to enjoy the drive, enjoy the highway with your family. But while exiting Delhi, you basically get stuck somewhere. And when you are stuck there, you see people around you on motorbikes whizzing past and somehow trying to overcome the traffic jam and move ahead. This is exactly what most of you or most of us feel like when you are sitting with your wealth creators like a Nestle or a Maruti or a Kotak, and these businesses are not moving for the last 3 months or 6 months. They frustrate you, and there is something else which would have very quickly just doubled in those last 6 months, and you feel that, look, it's been such a dead investment sitting in Kotak, Nestle. I've heard they are wealth creators, but they just don't move. You sell out your Nestles and your Kotaks to buy those businesses which have done well, which is no different from getting frustrated, selling off, getting out of your car, selling your car, buying a bike and trying to continue your journey to Jaipur. As absurd as this sounds, this is exactly what people do when they sell their jewels to buy something which has just been doing well in the last 6 months. So again, it's this question about having the ability to remain patient with your long-term winners. Now, this chart very simply shows how wealth has been created for this 25-year period between 1990 to 2015. And this is a chart which basically brings out the picture for the US markets. All of the wealth in the US has been created only by 20% of businesses. 80% of businesses have created zero wealth. Some of you may have heard of the famous Pareto law, which is also known as the 80-20 law, which is that 80% of all the events that happen around you are defined only by 20% of causes. 80% of all of the wealth created around the world is defined only by 20% businesses. And these 20% businesses are the true value creators. All others can go up, come down, and so on. Within this 20%, let me tell you, 10% of the businesses are really the ones which have created real meaningful wealth. Therefore, again, it drills down to the same point. Concentrate on the real profitable value adding, value accretive businesses. You will make money. Next, please. The problem here is it requires patience. And how can we ever have patience? Next, please. You see, Benjamin Graham, who was the guru of Warren Buffett, many of you may have heard that Warren Buffett only once in his lifetime left Omaha and went to New York because he had heard by that time during his teenage days that there is a professor of finance called Ben Graham who basically has that Midas touch. Whatever he touches turns into gold. And he thought, let me understand investments from him. And this is back in the 1930s and 40s. You can imagine, even then, human beings really had the same psychological problems of investing and holding on for the long run. People don't need extraordinary insights or intelligence to be a great investor. What they need the most is a character and basically adopt simple rules and stick with them. Next, please. Next, please. I think Rishabh made this statement, which Charlie Munger always says, great investment requires a lot of delayed gratification. You have to be patient with your businesses. I'm reiterating, we are not in the business of buying stocks. We are not buying mere paper. We are not buying concepts which will do well for the next 6 months, after which something else will do well. We are fractional owners of businesses. Behave like the owner of the business. Think about the outcomes of this business over the next 3 to 5 years, and you will make money. And this is where a Nobel laureate, Paul Samuelson, a noted economist, basically said, investing should be like watching paint dry or watching grass grow. If you want excitement, then please go to Las Vegas, because we are not speculating, we are investing. Next, please. Now, this is the most important chart, which I thought in the Indian context can actually sum up the entire discussion that we have had in the last 10-15 minutes. I will just interpret this chart to you. Don't get overawed by it. On the left-hand side are businesses. The first one is Asian Paints. The second is HDFC, not HDFC Bank, HDFC Limited, because HDFC Bank got listed much later in 1996. And this data is from 1991 to 2001. I've picked up 30 years of data. The next one is Nestle. I call them as three great value creators. And then I have taken popular common businesses, very big in their respective industries, do catch the investors' imagination every now and then. These are SBI, Tata Steel, and Tata Motors. Now, this is the power of compounding. On the extreme right-hand side are the annualized returns. Asian Paints 27, HDFC also 27, Nestle 23, SBI not too far behind at 19, and Tata Steel at 13. When you look at these numbers, 27, 22, 18, 13, actually doesn't look as if there's a big difference. But the big difference is when you look at the line in the middle, which is total return. Asian Paints in the last 30 years has created wealth which is 1,566 times of your initial capital. If you would have invested 1 lakh rupees in Asian Paints, it would have grown into 15.66 crores. 1,566 times. HDFC 1,472 times. Nestle 49 times. Just imagine the difference between Nestle at 49 times and SBI at 18 times, when the annualized difference doesn't seem to be too much. Lastly, Tata Steel just 40 times, Tata Motors just 20 times. This is the power of long-term compounding and thinking about businesses as owners and looking at delayed gratification, holding on to these jewels patiently while silently compounding is working for you. And by the way, I haven't picked up the best businesses. I have just picked up in both subsets the most commonly known businesses. Next, please. Lastly, last couple of slides. Look, all of these businesses will come expensive. None of them will become cheap. That's the biggest pushback that all of you would have. That, look, this is a great business. Why am I actually buying it at this price? Like I said before, in my entire career, I have never seen Nestle's and Asian Paints and HDFC trade cheap. I have never seen Tata Steel, SBI trade very expensive. Yet, choose the time period that you want to, pick them up at any price. The longer term difference between the two would still be visible, for the simple reason that one is a great franchise, eking out great economic value, and then not just that, compounding that great economic value year after year. Therefore, it is far better to pay a fair price for a great business rather than a great price for a fair business. You buy SBI at any price, buy them at dirt cheap price. Longer term compounding will still not be in your favor. You buy Nestle at an expensive looking price, hold on to it for a long time, the underlying franchise will still work in your favor. Next, please. I think I'll skip this in the interest of time. The previous slide, let me just interpret that for you. Actually, Rishabh, we can go to the previous one. I'll just quickly interpret this for you. This is what, again, Warren Buffett, who's supposed to be the propounder of value investing. This is what he himself has often been repeating in his annual meetings. That value investing is not just about purchase of stocks which have attributes like low price to book value, low price earnings. Unfortunately, these characteristics cannot determine whether an investor is indeed buying something which has value. At the same time, the exact opposite of this, which is buying something which has a high price to book value, high price earnings, is no way inconsistent with a value purchase. So if you think that Nestle is not a value stock, whereas maybe a Bajaj consumer is. Perhaps you are wrong, because what determines value is the underlying economic characteristics of the business. Compared to the economic characteristics, if the valuation is high in terms of price to book value, you are still buying something which can actually create a lot of wealth for you in the long run. Next, please. We'll skip this one, Rishabh. We'll go to the next one. This is the last slide on this topic, which is to support this argument of buying cheap versus buying expensive. For some of you who have been associated with the markets, I've been told I'm speaking to a young audience today, so I'm not too sure how many of you would remember this. Possibly many of you would have been toddlers at this point of time. This is when I started my career. Infosys was a stock which was trading at a PE of 100, 3 digits. And everybody felt that, look, great business, but it's already trading at 3 digits. How would we ever make money in the long run? Well, yes, for people who actually, were looking at it only from a 3 or 6 month perspective, they were right, because Infosys in the first half of 2000 did fall very sharply. February 2000 was the peak of the dot-com bubble, and we did see prices fall off. But do remember, we were not investing into any business. We were investing into a company which is once in a generation kind of company like Infosys. Therefore, while so many other businesses like a Silverline, like a DSQ, these are all names that of Me Too IT services companies that mushroomed between 97 to 2003. While all of them went bust, but we were talking here about a great franchise. Even if we bought them at a P of 100 times, and I've deliberately taken an extreme case, if you held it on for the next 5 years, despite such an expensive price, you still made 20% CAGR when the markets made only a 8% CAGR. I rest my case here about thinking long term, about thinking about businesses and their outcomes, rather than thinking about the behavior of their stock prices over the next few quarters. So that's the end of my presentation. We can open up for Q&A now.
Thanks, Mr. Tyagi. I think that was really insightful, and I think, as rightly mentioned, a lot of our viewers are quite young, and they would be amazed by seeing these numbers, and they would be thanking themselves that, okay, they are on the right track by investing at such an early age. So I think thank you so much for that presentation, and we'll now open up. So we will take the questions from the viewers. I think one common question which you would be getting in all your meetings is it the right time? Because markets look very volatile. So what you have to say? I'm sure you've made your case for long-term investing, but anything you would like to add to that?
You see, the point is that, investing is about getting the asset allocation right in the first place. I'm assuming that people, the audience that we are addressing today, are all in this phase of their life when they are saving. They are earning, they have surplus, they need to invest that surplus somewhere. When you are at a very early age, 25, 30, 35, there's a simple rule which I remember when I was in college. Somebody used to tell me 100 minus your age is what your allocation should be into equity. So if you are 25-year-old, 75% of your assets should go into equity. And the rule never spoke about timing the market. The rule never said that, look, you should wait till the time the markets reach to a particular P or a band and so on. The rule just said, have your asset allocation right, invest systematically, invest whenever you are getting excess surplus with yourself, so that when you start this process 60 or 65, you really have a very big nest egg. To that extent, I can say that, look, it always sounds very interesting and intellectually stimulating to talk about, is this the right price? Can the markets correct by 10%? Are there a set of events that are about to happen which would lead to a correction, and therefore should I wait for that time? I would say just invest with that discipline of basically being congruous to your asset allocation plan, which has been decided either by you directly or while you have sat with your investment advisor. Stick to it, do SIPs, do STPs, don't ever take your focus off the eyeballs. The last example that I can give you, again using numbers, is imagine you were Like me, you started your career in 99, 2000. Markets at that point of time were trading at a valuation of 4,000. They suddenly went up to 6,000 and then crashed, by the way. Within 2 years, they crashed and came back to, let's say, 3,500. Suppose I was making investments when markets were 4, 4.5, 5, 5.5. I didn't bother to time the market. Look at it in the context of the long term today. And by the way, 20 years is not really a lifetime, but still, is there a big difference in holding period returns from 4,500 to 50,000 plus and 3,500 to 50,000 plus? The answer is it won't move the needle substantially. Therefore, when you are living that moment, it looks that timing the market is important. But if you are really wanting to make a big nest egg, it is not as important. Yeah. Sorry, long answer to this question, but I thought it's important to rest all of these doubts in the minds of investors, because the most important question is for them, for our investors, the most important question is, should I invest right now? Whereas to my mind, the most important question is A, asset allocation, B, investing into great businesses.
Sure. I think much needed. Second question is somewhat very, very similar to this one, because a lot of time when we say long term, people are not able to make a time period into mind. So whether it is 3 years, 5 years, 10 years. So how do first time investors or young investors keep that in mind when they're looking at long term?
Rishabh, the easiest thing for a young investor to do is forget the time frame. Like I said, a young investor, I would suppose, is in a period of saving. He would not require to dip into those savings, hopefully, for the next 20, 30 years. So why even bother about that? If you're asking me a generic definition of long term in the context of investing into equities, I would say at least 5 years. I would want people to get more disciplined and therefore look beyond 5 years. But I think equity investing as a culture, as a cult in India, is still very young. And therefore, I would say, please do look at least a 5-year period. Hopefully, when people have really enjoyed and seen the power of compounding, it will be easier for people like you and me to explain to them that, look for at least 7 to 10 years. But as of now, at least a 5-year time period, no less.
Perfect. Another question, if people are starting with 1 or 2 funds, can flexi cap or multi cap be there in their portfolio as their starting point?
Sure. I think that's a very good question, because now we are really drilling down to the vehicles which we have to write to meet to our objectives. Flexi cap is the category in the country which basically allows you the elbow room to maneuver and invest across large, mid, and small. It allows the portfolio manager to express himself by investing across market cap buckets without bothering about regulations. So therefore, from that perspective, it basically, to my mind, should be the core of any of our investors, whether a 20-year-old or a 50-year-old. The core has to be a fund which basically can invest and take advantages of new ideas, where those new ideas could be large caps like a DMart or an Avenue Supermarts or a Zomato, which is about to get listed. Those new ideas could be a much smaller company like a Barbecue Nation, which recently got listed. So the core should be FlexiCap, and therefore that's a great starting point for any investor of any age group. Yeah.
Perfect. Shikhar, I would like to ask, I think some viewer have asked a question saying that they're already doing SIP directly with AMCs. They would like to shift it to Groww. So will there be any charges on that? They wanted to know.
So if you're doing it on any AMC, so there are, I want to understand 2 parts to this. Actually, no, I don't think we can have a two-way conversation with the person who asked. So I'll just answer the both sides of this. If you're talking of withdrawing money from that and moving it to Groww, in that case, if there is any exit load applicable, then you will have to pay. If there are any taxes relevant, you will have to pay those, which there will be, depending on how much the amount is and what your capital gains are. And if you're moving them from a regular to direct, you will have to withdraw. There's no other way. If it's already direct there in the mutual fund app and you want to move it to Groww, then it's simply importing them. Then there's no requirement of withdrawing. So there probably won't be any charges on that.
Thanks, Shikhar. Moving back to you, Mr. Tyagi, small caps, I think when markets are doing good, there are a lot of questions which people have for small caps. So one of our viewer wanted to know, for a 10-year period, is it a good time to look for small caps, and in particular if you're looking at sectors? So I'm just clubbing another question. For 5 to 10 years, if somebody is looking for sector investing, which all sectors are looking great at this point in time?
Sure. I think yes. If you do have a 10-year time frame in front of you, small caps is a good space. Of course, they have run up. I'll again go back to one very fundamental basic concept that we have to understand, and you need to understand this from the perspective of opportunities, size, or landscape in front of you. When you invest into small caps, do appreciate that there are certain businesses which would not be on your radar. For instance, if you want to invest into the best banks or financial institutions in this country, now which is the small cap that you would be able to ride on? You can't ride on HDFC, Bajaj Finance, Kotak. All of these are out. Possibly if Paytm gets listed, it will not be a small cap, it will come as a large cap. So the generic problem with investing only into mid caps, investing only into large caps, investing only into small caps is you have basically shrunk the landscape for yourself. A lot of companies that I showed you on the screen previously are already past small caps. So bear that in mind. But yes, if it's a generic question, I have a 10-year time period. Should I invest into small caps? The answer is yes, because small cap investing does require a longer time period. If I said 5 years for equity investing, I would have easily said 7 to 10 years for small cap investing. But I just wanted to give that caveat. When you invest into specific stocks, into a market capitalization bucket on one hand, or into specific sectors, you are basically denying yourself the opportunity of a much larger canvas. That's point number one. Point number two was sectors. I think that, the way Indian economy is positioned today, I would say there will not just be 1, 2, or 3 sectors. Again, because you have asked this question from a 5-year perspective, there will be multiple sectors which do well. My favorites are, of course, consumption-driven sectors. For the simple reason, despite the hard work done by all of us in the last 30 years as a country, and I'm saying this, we are still at $2,000 per capita income. You see, even our immediate neighbors in the emerging market landscape, and I call our neighbors in this landscape as Brazil, China, South Africa, Russia, because these are the countries we get compared with. All of them, except for China, are much smaller than us in terms of size, yet their per capita incomes are $8,000, $10,000, $12,000, and so on. The Western world is at $30,000. But the good part is that in the last 10 years, our per capita income has been the fastest growing around the world. As this income keeps increasing, our consumption will keep increasing. Not only consumer staples, consumer discretionary items, autos, healthcare is a very big consumption theme, by the way. So I would say all of these sectors which are related to the growing per capita income of our country, therefore growing disposable income in our country, will lead to very strong tailwinds for businesses which in some way or the other are directly or indirectly consumption-driven businesses. So those are my favorites. There would be companies in consumer goods, both staples and discretionary. There will be companies in pharma and healthcare. In autos, there will be such companies. And in the end, there will be financiers of this consumption, which are the banks, who are financing you for buying that house, for buying that car, for buying that LED TV, for furnishing in your house, and so on. Yeah. So that's how I think I would grade the opportunities.
Sure. And you've also mentioned about while picking the stocks, I think return on equity, cash flow, I think less of debt. These are some of the elements to look for. Any other things generally our viewers should keep in mind while selecting businesses? Any other parameters to look for while selecting stocks or companies?
Sure, Rishabh. I think the most important factor, of course, that was not in the scope of the presentation today, but the most important factor beyond the ones that we listed out is corporate governance. If you have put in your money with a management which is not above board in terms of their dealings, where there is a suspicion about their governance, then believe you me, as an investor, you will not be able to create long-term wealth because, like I said, you're just being a part owner. So this is about, imagine this as you being part of a partnership firm. You're a passive partner, not an active partner, but your active partner basically has his hand in the cookie jar and he is just trying to steal cookies out of it. No matter how well the business prospects are, you will not be able to derive sustainable wealth out of that business. The same thing is for all of us who are one of the many lakhs of shareholders. If the guys managing that business have their hand into the cookie jar, we will not be able to create wealth. So do look for strong corporate governance.
Great. I think that was much needed. Last couple of questions. I'll just quickly ask both of them because I see there is a link between both of them, and then we can wrap this show. Is somebody saying, can we just invest in top 10 stocks or top 10 valued companies and don't go for diversification? And another one, investor, they want to know about index funds. So if you can just clarify on both,
Sure. Let me talk about the second one first. You see, no offense meant to anyone. Each product offering in the country, in the suite of products that all mutual funds offer, is important, does actually serve a purpose, at least if not for everybody, for a select set of investors. Therefore, like I said, no offense meant, but I consider index investing, ETF investing to be dumb investing. All that we are doing is, look, these are the top 100 stocks. I have no idea about the prospects of these 100 stocks. I have no idea about their corporate governance. I have no idea about their ROEs. All the basic things that we need to study about investing into a business. We have no regard to them, but we just say that, look, we will invest into an index, and therefore we're not even bothered about the constituents of the benchmark. It serves an important purpose because a lot of people say that, look, I don't understand how do I select the best fund managers. So let me not take a call on the best fund managers because I just don't know who's the best out there. Let me invest into the markets per se. I'm happy with the market return. Therefore, it's not a wrong way of looking at it. But if you do that, what you have done is you have locked yourself permanently into what I call as average returns. Because the best of investors, the best of portfolio managers will over longer periods of time create alpha. It is for people like you, people like Shikhar and platforms like Groww to figure out, look, just like the Pareto law, 80-20, 20% of businesses create all the wealth in the world. 20% of the best cricketers in Maharashtra will go on to play Ranji and not the entire lot. Therefore, similarly, only 20% of portfolio managers in this country will have the right to, not the right, but would have the ability to create sustainable alpha over long time periods. If you have the ability to select those 20% portfolio managers basis their thinking, basis their past track record, then you are not locking yourself into average returns. You are giving yourself the prospects for better than average or better than market returns. That's your question number 2. So therefore, as an active investor, I always feel why to lock yourself into average returns. For somebody who can't do the heavy lifting, can't figure that out, very well, do that. For somebody who can do it, why are you starting your hypothesis with a very middling or averaging kind of returns? Your first question, I'm sorry, in this entire,
viewer wants
reply,
to know.
I forgot.
No problem. Instead of investing into a diversified portfolio, if they just select the top 10 valued companies and they put their money into that.
Perfect. You see, it is in some sense a subset of what we just discussed, which is index investing. Now, do appreciate a Page Industries would come into the index, and that's the reason why index will always be middling or average. A Page Industries will enter into the benchmark 20 years after it has shown you a fantastic return. If you look at our portfolio, we invested in Page 10 years back when the stock was 800 crores market cap. Today is 31,000 crores. Still not part of BSE 100. Will take another 5 years for Page to become part of the index. But you have lost out that opportunity. If you're investing in top 10, it is an extreme case of index investing itself. Here I am trying to explain that why invest in the top 50 stocks only. If you are saying that, look, forget top 50, I will invest only in the top 10, then you are actually going into a further silo, and you are denying yourself the prospects of Astral Poly, Page Industries, Jubilant Foodworks, PI Industries, all of the wealth creators of the last 10 years, which may take another 5 to 10 years to come into the benchmark. Forget top 10. So no, I don't subscribe to that view at all. You are limiting your landscape. Don't limit your landscape. Value and future value creation is not the birthright of the top 10 or top 50 companies in this country. So I would never actually advise that.
Great. I think that was very, very direct. And I'm sure today our viewers have got a lot of insight which they will use and create a lot of wealth for themselves. So thank you, Mr. Ajay, for coming on our show and giving a lot of insight for long-term investing. I'm sure our viewers have loved it. Thanks, Shikhar, for joining in like always. All the best to all the investors on their way to long-term wealth creation. And we will meet again next week with a new guest speaker and a new topic. So till then, stay safe, stay healthy.
Thank you, everyone.
Thank you. And sorry about the problems at my end.
No
Enjoy
problem.
the weekend.
Happens. Yeah. Thank you.